Hello and a very warm welcome to everyone. I am Shrija Agrawal and you are watching our special dispatch M&A in the Next Normal. Before we get into a conversation with this extremely meaningful August panel here, let me try to contextualize what we are doing here today. Now, financial investors and key stakeholders are not unfamiliar with financial crises and ups and downs, but there always seems to be some playbook to deal with it. Yet, for some reason, COVID 19 did not have a playbook to begin with and was termed as a black swan event like none other. As organizations got jolted out of their black swan blindness, there was an increasing realization how the meaning of risk has changed forever. Added to that, there was also people were worried that due to a market disconnect and severe volatility, perhaps M&A would be hit. Now, M&As have dealt with tough times, such as the dot-com bubble burst in the early 2000s and the Great Recession of 07-09. Buyers could delay or pull back acquisition plans. Yet, while investors were scrambling to figure out what to do, thousands of enterprises shuttered and scores of employees were followed. M&A seems to have bounced back, and like how? Sure, there are many cases where M&As didn't go through, like the SoftBank and the Xerox case. There were many areas where it did continue. Experts posit that essentially this is because of the high liquidity in the environment that we are seeing right now. Also, private equity went in 2020 at all-time high, and there were eager buyers and eager sellers. Was the access to technology and a growing digitization trend a key factor to maintain continuity for acquisition mechanisms is a good question to ask. And what really is the future of this going to be like? Would there be more M&As in places where investors think they would get bargains for organizations in disproportionately affected sectors? What would the availability of debt financing really be with the cheap capital now post the pandemic? And finally, the most important question to be posed to all the experts and business leaders here is what really are the considerations, both from a buyer's and seller's perspective, for a successful post M&A integration? I'm extremely fortunate to have with me two business leaders who have undergone M&A experience to share some real on the ground insights with me today. Please help me welcome Craig Dempster and Sunil Mirani. Craig Dempster is the global CEO of Merkle Inc. Craig is responsible for customer experience management service line, which encompasses capability and solutions in CX transformation, technology consulting, and more. Please also help me welcome Sunil Mirani, who is the co-founder and chief executive officer of Ugam, a technology company part of Merkle. Sunil has an overall responsibility to shape the company's strategy to be in line with its purpose, values, and mission. First of all, gentlemen, thank you for coming to this show and thank you for sharing your time and energy for this. My first question, really take it from the context and rooted right now. The world is flush with capital and M&A is an all-time high. How does one really retain sanity at a time when liquidity is all around to see the private equity, the venture capital model is being disrupted, while we see technology and digital transformation, so to speak, disrupting companies? The VCPE model and the fund managers themselves have disrupted themselves in the world of SoftBank and Tiger Global. What will be the driving factors for collaboration going forward? We saw consolidation playing a huge role for deals in this last year. What will be the case in 2021? I would like to begin with you, Craig, and then on to you, Sunil.
Sure. Great. Well, first, thank you for having us. We appreciate the opportunity to speak with the audience today. Yeah, as you said, it is there's a lot of capital out there, and M&A will continue to accelerate here as we look into 2021 and 2022. In our space, which is really the technology services space, you are seeing a tremendous amount of comeback from the pandemic, with strategics who went on the sideline during that time to see how things would pan out, and now have gotten very aggressive in terms of looking for new opportunities for M&A. At the same time, you're also seeing, as you said, a lot of private equity money coming into the space, and this is creating increased valuations within the space, more competitive nature, different deal structures associated with deals. So the market will continue to be frothy here, globally, and technology services is obviously a space where there's a tremendous amount of investment pouring in.
I come to you now, Sunil. We just heard Craig, and he said that the
Yeah.
froth will continue in the environment going forward, and technology really seems to be at the heart of deal making. I mean, if there are two words which we have completely seen in the pandemic being bandied around so loosely, is digital transformation. I wonder what really is your sense in the M&A going forward for the rest of this year.
Yeah. So firstly, again, thanks for having. It's great to be here. So yes, there is the liquidity angle, which both you and Craig spoke about. The other macro context is the whole disruption and the opportunity that is happening after the pandemic, right? And it's that's why some commentators have called this the Roaring Twenties, which is just like exactly 100 years ago, right? In the 1920s, just after the World War One, that saw a decade of unprecedented growth. And that time it was those disruptive technologies of those days, which is automobiles, radios, electricity in the household, etc. This is very similar to that, except it's different. AI, ML, quantum computing, all these new technologies. So given this macro environment where there are these disruptive technologies, and I dare say humankind has never seen something like this, there are always going to be opportunities. And there'll be, and in such a case, there's a threat to the incumbent and there's an opportunity for newcomers. So there'll be many newcomers here who will try to, in this, it's a green field now with so many new areas, there'll be newcomers who'll come in and try to take advantage of the opportunity. And there are incumbents who might feel threatened, and they will do their own moves again through M&A or private equity, right? And we've seen, especially these two, three areas, right? Craig referred to the direct to consumer. It's more like the DTX, not just DTC, direct to consumer, to the subscriber, to the patient. You're going to see companies going direct across. You've seen that in India, right? Reliance acquiring, right, from your Savan to your Urban Ladder to what have you. Tata is doing with Big Basket and 1MG, Marico acquiring Beardo. All these other companies going and buying directly. So that's more the B2C. And then in B2B, like Craig was saying, given the whole tech services, Accenture is still buying two companies a month. Infosys continues to buy a month. Uh, Craig has a wallet full of cash, which he's looking to spend on in terms of other acquisitions. So yeah, I think the opportunity macro conditions are ripe for M&A to continue so long as the liquidity remains.
Craig is actually showing his wallet to us. So, is this actually a very pandemic induced growth? One can also say that people are actually making hay while the sun shines. And how long will this be sustainable? Can one say that all of this is also because there's so much of liquidity given the US China relationships that we're seeing right now? A lot of that money that could have gone to China is actually coming to India. I mean, crazy valuations, deals are happening at breakneck speed. There's no sanity being seen in the private capital markets. We haven't really seen this ever. So, how sustainable this is? And there are two sort of views to this, Craig and Sunil. One is that people say that the outcomes have become so much larger that the private world will put so much capital to work. And they're rationalizing this with that kind of reasoning. But there's other which is saying that the VC world has perhaps gone bonkers, and this is the next normal or the new normal for the VC world, and we have to accept that. I wonder, I'll begin with you, Craig, what really is your view, and also get Sunil's view on this unprecedented private capital money.
Yeah, well, first of all, I think everything's a cycle, right? So it's really how long the cycle will last here. And I really believe that it's going to be frothy here for the next few years at least. And a lot of it, as I think about our space and Sunil's comments, I mean, customer experience management and customer experience transformation is the way that brands are built today, right? And it's all enabled through data technology and analytics. And so I think that it will continue to be a very hot market for the next few years. And as I look at it's not only the availability of capital, it's the progress of change that Sunil talked about. Innovation is happening so quickly, and new channels are opening up for consumers to have experiences in, and the progression of new technologies is happening at breakneck speed. So I don't see an end in sight here for the next few years at least. And I think as entrepreneurs, it's a tricky situation right now, because I think you could sell too early, right? Because you want to take advantage of this period in time and get the highest valuation that you could get. On the other hand, we're going to also have a frothy business environment for the next few years, right? So you could really grow and increase your profits over the next few years. And even if multiples decline a little bit, on the end of that, you could still end up in a great spot. So it's a tricky time. And I often think, and Sunil and I have talked about this before, that a lot of entrepreneurs, they sell too early. They sell too early, especially in the services world. You make money in the services world, right? It's not like technology where you're pouring money in to develop something and you're hoping that the market catches on to it. And then when it does, you got to take advantage of that opportunity. You're in a services business, you're making money. You can, as long as you can continue to grow, you're going to continue to increase the valuation of your business. So it's a tricky time for people to make a decision about, is it the right time to sell?
That's a sort of a pretty good point, and that actually brings me to my next question to you, Sunil. You are an entrepreneur and you went through an M&A process. So, what really is the right time to sell? And I've heard this from other leaders also. What Craig just mentioned, that perhaps Indian entrepreneurs become too happy too soon. Do you see, is that changing? And right now we are going through a very tricky situation because liquidity is just so much and can get extremely tempting for entrepreneurs to cash out at extremely unreasonable valuation.
Yeah. No, so frankly, yes and no. I don't think there's one right answer on whether it's too early or not. So for first, just rewind a bit. I think Craig's absolutely right. The environment is so awesome from an entrepreneur's point of view that there are opportunities galore. Now, when the party and the music will stop, one doesn't know. But we've seen enough. At least I've seen I've gone through the dot-com mania of 99, 2000 to know fully well what goes up has to come down. It can never there. So the whole new normal that this is the new one, I don't know about that. But anyhow, the fact that there are lots of opportunities, certainly true. What's the right time, and do you sell too early? Actually, I don't agree. I think for every entrepreneur who feels that they've sold too early, I guarantee you there are 10 who wish they had sold when they had an opportunity to do so. I personally know entrepreneurs who held out for the long term and now that business is gone or it's lifestyle. So no, I don't think I can agree on that. And people, when I say that, people tell me, okay, look at Instagram, look at WhatsApp. They could have been so much more had they grown. But it's counterfactual logic. They are probably where they are because they're part of Facebook. If they were not part of Facebook, who's to say what would they have been, right? So now, what's the right time to sell? I don't know. I don't think there's a right answer. It all depends on the person, on the founders of the company, and there could be many reasons, right? There's a school of thought which says that, yes, you build your company like you would your apartment, right? If you were looking to sell the apartment, rent it, or live in it, you'll furnish it accordingly, right? But I don't believe that. We just focused on, boss, we want to build a company which is valuable. Valuation will follow. So first 18 years, we didn't even think of it. There was never a discussion on whether we should sell, not sell, whatever. Time came for us to address the question. We undertook a process, and 1 year later, we are where we are. So I don't think there's one right answer. It all depends on the founders, their situation, whether they, maybe some case founders don't get along. Maybe in some cases, founders are just tired and they just want to go home and cash out, which is fine too. That's the founder's part. The important part also is what's good for the company. And that's very difficult, right? That while on one hand, yes, in entrepreneurial companies, the founders and the company is kind of intertwined and the objectives are intertwined. At one level, one has to look at what's right for the company. In certain industries, you might be reaching an inflection point. There's a lot of disruption coming. Maybe it's best interest of the company to sell out and be part of something larger. And that's very hard for an entrepreneur to look in the mirror. And it's almost an admission of defeat, right? That, okay, I can't do it. It's beyond me now. Let me sell out to someone else. But so I think one has to look at both the founder's point of view and the company's point of view, but there's no right answer.
Okay, that was interesting. So perhaps the motivations could be many and will come to the fore, like what you mentioned from an entrepreneur's perspective. The capital could be huge, and you also have to think from an organization's perspective. And in most cases, in entrepreneurial organizations, both could be intertwined. And in hindsight, everything looks good or bad. One doesn't really know the answer. And so we have
If
spoken
I'd
about.
seen the size of Craig's wallet now 2 years ago, maybe I would have held on a little longer.
I think Sunil is after your wallet. Really, the size of the
He
wallet.
really is. He already has it.
He already has a good share of it. Yeah. So we spoke about quite a few things. We spoke about the liquidity in the environment, how the frothiness is bound to continue, and perhaps both of you agreed that we're not necessarily at the end of the cycle. We're in the middle of the cycle, so to speak. You also spoke about the founder motivations, what comes to the fore while selling out, and perhaps it's not necessarily the right time, by the playbook, when to cash out. What we're also seeing back home in India, that there's a huge beeline amongst internet companies for a stock market debut, especially from the Indian bosses. And this is a huge departure from what we saw earlier when everybody was flying to NASDAQ for a NASDAQ listing, perhaps thinking that there the valuations would be higher. And perhaps people understand internet companies far better. But we just had a blockbuster Zomato IPO, which was a hugely loss making company. And when I contrast this to a very successfully run listed internet company like InfoEdge, which went debut 10 years back, the answers I get is that perhaps the Indian investor has changed quite a bit. Perhaps there's a huge understanding of internet companies, or so to speak. I want to understand from you, Craig, given that you operate in the Indian markets and you're looking out for opportunities, what are you making out of this debut of loss-making internet companies to be listed on Indian bourses? How anti-fragile can they really be? Is it just about reaching a top on the day of listing? Can you really sustain that number is a big question. So I want to ask you this question and then go on to Sunil for his views.
Yeah, so a couple of things here. One is that I think you have to kind of look at tech. You have to, from our perspective, and I'm talking about from our industry. There's technology developers and makers, and then there's technology services, right? So I think that for technology providers, the IPO and going to the public markets can be the only way to truly realize the types of valuations that people dream of. Whereas I think in the services space, I think that's a much harder path to go, to go to the public markets to look for your exit strategy or to look for. And I also think getting back to the entrepreneurial side of things. Obviously, we at Merkle, we grew up. We started it, 30 years ago as nothing basically, and now we're a $1.5 billion organization. And we obviously looked at all of our strategic alternatives. But as we thought about the public markets, we thought about the pressures of having to manage the business, 90 days at a time. And as an entrepreneur, that's the last thing that you want to do. You want to think about the next 90 days, but you also want to think about the next 10 years. And the context is, what's my 10-year vision and what am I doing over the next 90 days to get there? And you also have to be able to invest appropriately in the business. As a services company, margins are extremely important, right? Whereas a tech company, it's really, the market gives you valuation predominantly on your growth rates, right? And so my feeling is that the IPO market, for every one company that hits it big, there's 9 that fail. And you could say the same thing for those companies that don't go public, but I think there's a better long-term opportunity, especially in the services space, to stay out of the public markets. Whereas tech services, it's binary. You either it's 1 in 10 make it, and you're just trying to be the one that does.
I agree.
What would your views be here?
Yeah, only thing to add, it's also a function of whether to do IPO or M&A. Again, it varies. One is Craig's point, right? Tech services versus the underlying tech provider. The other also is about why are you trying to do it? See, either you do public if you have an institutional investor who needs to exit, maybe the founders don't and they don't want to dilute. This is one good way to do it. Go to the public markets. It's a secondary offering. The institutional investors get their exit and the company still goes on, right? Second could be maybe you want to just raise the profile of a new category, right? So Zomato is one of the first few in this new age kind of B2C internet companies which is going. So one of the first of those kind. Great way to get a valuation and kind of almost give rise to a category of companies. And that's equally true in the B2B world. There have been enough cases in the US. One of our partners, Qualtrics, they went public only because they wanted to create and evangelize the space that they call experience management, right? Except so that could be another reason. And third could be, the amount of funds you can raise through the widest possible investor base if you go public. It's unparalleled, right? So those could be the other reasons you might think of if you want to go public. But again, it all boils down to an individual entrepreneur's and founder's choice. In our case, was much like Craig. There's no way we wanted to, look at running the company 90 days at a time. You're in a fishbowl all the time, and that's just not that was not for us.
Definitely, if you're going for a public outing, you have to be very, very open to public scrutiny. And like you mentioned, you have to be extremely ready for quarterly earnings. And I wonder how many internet entrepreneurs are really open for that. Because there will be an analyst at a broking firm with a microscope in his hand and actually scrutinizing all your numbers. And then my next question, this entire interesting observation about M&A versus the IPO is one coming to the fore. And I think the interesting follow-up question to that really is that M&As historically have not really been so successful. And there's nothing like a bad M&A. I've seen large organizations coming together, employees are asked to leave, and the culture, the so-called culture integration does not necessarily happen as much as the leaders would want that to happen. And how does one really build a sustainable and resilient organization just backed by good governance, digital capabilities, robust business models, which is expected to drive collaboration in the future? I know there's not necessarily a correct playbook for this, but both of you are perhaps the best suited to share some insights into this, having gone through a on-the-ground M&A experience. I'll begin with you, Sunil, and then go to Craig on this. Maybe perhaps you can talk from a buyer's perspective and from a seller's perspective, and Craig from a buyer's perspective. Yeah.
So that's a good question. So from a seller's perspective, firstly, why did we look at M&A, or why did we even look at anything at all? It's only because we were private for 18 years, and there were one set of shareholders who kind of wanted an exit, right? And some others, such as me and my partners, who wanted to carry on. And we thought the fairest and the best way to do it is run a transparent process and let the market decide the value. So that said, with that as an objective, we went out, we met, did our beauty parade, so to speak, and met, many companies. And we also had a choice, and we selected Merkle for a reason, is that, we wanted to be clear on 2-3 things. One, from a commercial point of view, yes, the shareholders had to be happy, both the one who were exiting, so they should get the best and the fairest value possible, as well as look at the continuing shareholders and under what condition they have to stay. So that is one, taking care of the shareholder. The other would be customers. Would this be a company who will continue to support our strategy towards delighting our customers, and will we get all the backing and support that we need? And third was all the employees. What's going to happen to the employees, and what's the rationale for them wanting to acquire us? So we looked at all of this, and of course the handsome Mr. Craig Dempster. So that was, I think, the clincher of it. So we looked at all these aspects before we made, and that's why. And I'll come to the culture part later. I think maybe you only touched upon it, but it warrants 5-minute discussion on itself. So I think above all, that was, from our point of view, 2 things. One, financially, I think more or less everyone was on the same page, but 2 things stood out. For one, we were a it was obvious that we were a good strategic fit for culture, I mean, for Merkle, because of what they were seeking, which is advanced analytics capability and an India kind of springboard for their larger strategy, which they explained. So it was very clear that we would not just be a small fish in a big pond lost somewhere else and just added on to a mass of 100,000 people who are already there, but we will be an important peg in their growth strategy. So that was important because that would set the career path for the employees who are acquired. And the whole cultural fit, right from the day one, we felt like there was a kindred spirit. It just felt like you were part of the same company, and all the interactions were just wonderful. So that's why we kind of selected them. Now, is that a success? Well, financially, I don't know. Craig can answer. He's the one who emptied the wallet, not me. But if I see it from a customer point of view, absolutely. We've lost 0 customers. We continue to gain traction across all our customers. All our financial metrics have only been up since acquisition. So that's a big check. Are our employees happy? Yes, they are very happy because we've continued to see great growth for them, and there's a clear growth path they see in the larger Merkle and Dentsu world. So I think overall, I would say, at least from a seller standpoint, I would consider this a great success.
What
Buyer
about you?
standpoint, Craig needs to answer that. So.
The ball is in your court now.
Yeah. So I have a lot to say on this subject, but and I sit in the buyer seat and the seller seat. Remember Merkle? We sold about 65% of the company in 2016 to Dentsu, and we completed our earnout earlier this year. So I went through the entire sales process, and I've also been involved in 20 plus acquisitions that we've done over the past 15 years. And for me, and I've spent time with hundreds of management teams, literally hundreds, evaluating whether they would be a good fit for our organization or not. And I usually know within the first 15 minutes whether this really has an opportunity or not. If somebody's sitting across from me and they're talking to me about, how they built this company and sold this company, and they built that company and they sold that company, and then I'm done. It's over for me. I'm not looking for built to sell. I'm looking for built to last, right? And so, you think about what Sunil said, for 18 years, they didn't think about it. They didn't even think about it. So, especially in the services space, it's so important. So, and business is personal. And so, to Sunil's point, it's about the engagement with that management team. A lot of people will send their M&A teams in to do all of, this kind of evaluation of whether this company would be good. For me, I've got to be in there from day one, and I've got to be involved in the process, because I've got to say, is this going to be culturally right? Do I see the opportunity for this business and our business to flourish together because we're like-minded people? And so, and then, so obviously culture is huge, because business is personal and you want to, and look, I mean, if you had told me 15 years ago that I would travel 8,000 miles from my home and find a company in India that had the same belief systems and culture that we had at Merkle, and if you had told me that the founders would become some of my closest personal friends, I would say, come on, really? And that is what has happened here. So it's tremendous. The other side of it is you have to find synergies, right? So trust comes when your employees start to work together, and that typically happens, through winning together. And so you can put everything on PowerPoint about how great it is, but culture equals behaviors, and behaviors equals culture, and you have to have people feel that, and the way that they feel that is through working together. So, and then finally, my biggest barometer for the success of an earnout or the success of an M&A is how long does the management continue to stay, post the deal being over. And if they stay, it's because you've built a platform that they're excited about, and it's a culture that they like to thrive in. And on the buyer side, I think it's very important that you have a company that the employees of the entity that you're acquiring are excited about and see something that they can grab onto, because typically, you know, they've been involved in this entrepreneurial company and it's so strong in its culture. If you don't have a strong culture for them to grab onto, you know, they're always going to be looking at you and saying, you're not what I was. And so you better have something strong for the employee base to grab onto and get excited about.
I just, Shrija, add a couple of things to validate that, right? So, to Craig's point, you know, in our process, we started with about more than, I think through the process, I must have met 45 different companies, and then gradually it filtered down. Merkle was the only one where I met the chairman and CEO. So David, who was the founder, and Craig, the only company where the first two meetings had the chairman and the CEO. All others went bottom up, right? Finance team or some business teams, and then after the event reached the next level, this was the reverse. So that itself was indication. So very first phone meeting, two of them were there. The very first in-person meeting in Bangalore, I said, after in New York, then we met, they were there. Then we said, okay, guys, you know, this looks interesting. Come to India. They were there. And then again, of course, all the teams kind of get involved, right? So that's one. That's another validation of what he just said. And second, you know, the employees got to feel excited. So I had involved my leadership team, right? There were 8, 9 of us. When we came down to the last 8 odd companies, I got all of them involved and we sat through all the meetings. Right? And after every one of those initial meetings, we'd sit on the table and say, what do you think? Right? Type of a thing. And moment that first meeting with Merkle happened, in Bangalore, I remember they had come down. They all looked at me and said, listen, Sunil, just do it. I mean, this is it. You know, these are the guys. It feels the same. The jokes are the same. The way we look at, you know, business is the same. Maybe color of the skin is different. Other than that, everything is same.
I mean, the facial hair is the same.
But I'm more handsome than you, Craig.
Oh wow, that really is huge cultural alignment. I can totally see that. I know we spoke about the positives. You know, both of you very beautifully pointed out from both from a buyer's and a seller's perspective how it was a meeting of minds and how the employees in your case also you said so choice and you chose Merkle. So it was not that Merkle came to you, you chose them. That was a very important point from a seller's perspective. Although from a buyer's perspective, what you highlighted, Craig, is a very important point that for you it was not about build to sell but build to last, and that was a trait that stood out for you in this case. Here's a company which actually was bootstrapped, which stayed till 18 years, and what they did. I want to understand is that we spoke about what really can go right, but now let's spend some time on what really can go wrong. What are the red flags or the warning signals that both buyers and sellers should be very cognizant of, or should perhaps must watch out while doing the deal? I'll start with you, Craig, and then get on to you, Sunil.
Yeah, so I mean, the first one's obvious based on the previous conversation, but you know, what can go wrong is that you have, you know, cultures that are not in sync, and that you have values and belief systems that are not aligned. I think culture, you know, incompatibility is the biggest, you know, detriment to M&A. It just, you know, it becomes ugly and bitter, and people take sides, and that is the one thing. The other is that you don't realize the value at the intersection of the two, right? So if you can't really see a true value coming to both sides, then you're not getting the interaction between the two organizations appropriately. So I think that, you know, if you're not getting the synergies that you're looking for, especially in terms of growth for the, you know, business that's being acquired, then you certainly, you know, can run into failures there. The other is surprising, is when either side surprises the other side. So I always say, look, get everything on the table before the deal is done. Like, this is what we're going to do. This is how we're going to do it. This is how we're going to structure. These are what our goals are going to look like. Now, certainly the market can take you in different directions and you have to pivot. But by setting clear, getting clear alignment in that process, if you don't do that, then everything's a surprise, right? Well, you didn't tell me that. That's right, because we didn't have the discussion about what it was going to be like. So, just to summarize there, I think cultural compatibility is critical. If you don't have it, you will fail. If you don't get the synergies that you expect at the intersection of the two, you will likely fail. And then if there are a lot of surprises along the way, because you didn't, work together to build the plan and get alignment around that before the deal was done, you're likely going to have a lot of tension points because people are going to be surprised a lot.
Yeah. Sunil, you want to add to that, what sort of just Craig mentioned?
Yeah, so if I look at it from a seller's perspective, right, if I, 2 years ago when we were going down this, two things are very important for us. One was deal certainty. So we wanted to make sure we align with someone and who had a track record and reputation that when they put the LOI or letter of intent, it will convert into a closed deal. That was number one. And second was that, which is related to deal certainty, is that whatever they say, the price that they give in the LOI and post due diligence pretty much lands out to be as such. And to Merkle and Dentsu's credit, that both ticked off, right? So, and I think we did our own background check, and I think they also shared their own track record of almost 98% of deals where they signed a letter of intent did get converted, or some said very high, ridiculously high number. And in most cases, the number that they give, usually in an LOI, it's a non-binding offer, right? It's an offer and based on terms and conditions. And yes, you do the due diligence, etc. And then we landed up at exactly the number that they quoted. Now, I say this because we did encounter one or two which are very different, right? And that's one red flag to look for, right? If you look at one who gives a ridiculous price, but then lots of fine print and conditions, that that's a case where they give you a price, lock you into an exclusivity, and then kind of drag you down, right? And that's no good. So that whole pre-deal, the deal certainty is important, and I think that worked out well. And the second, which impacts the post-deal integration, etc., is to understand right upfront what's the rationale for this particular company to buy you. So in our case, we spent time understanding that, and to David and Craig's credit, they explained their own. It was as much a beauty parade both ways. Just like we showcased our company and etc., they showcased what is their strategy, why they want to, what's their game plan next few years, what's missing, and why do they want to acquire us, and where will we fit in their scheme of things. And I think that was important. Back to my point earlier, right? We wanted to make sure that we were not just small fish in a big pond or just added for the sake of bulking up revenues. It was very clear to us that we were fulfilling a strategic objective and a strategic gap in the portfolio, which would make it a win-win. So I think it's important to be clear why you're being acquired also, and what's the role going to be for you and your colleagues in a post-acquired world.
That is pretty interesting. So it has to be an equal partnership. So while you were showcasing what you bring to the table, the other party, the buyer, was also showcasing why would they want to buy you. That's a pretty interesting point. Now, I also want to understand that in the hindsight, now that you have these parameters that you mentioned, Sunil, that your employees are happy, there's a clear path for them, you have your client base is increasing. So how does one really measure or calibrate, how successful an M&A process really has been? And specifically, this question becomes relevant in these times where deals are really happening when FOMO seems to be playing out, especially in the allocation of capital. One doesn't really know what he or she is doing. For most parts, there's some bit of too much of irrationality and exuberance also in the market, I would say, especially in this time. So how does one calibrate the success of an acquisition? Do you think technology also helps you do that, to gauge and predict analytics, an acquisition with greater accuracy, giving rise to better decision making? And what is your sense there?
But maybe I can go first, Craig, and then chime in. So again, I can only speak from a seller's perspective. So metrics, I'd look at hard metrics and soft metrics, right? If you look at hard metrics, in our case, it's more on, has there been anything which impedes our growth? So if you look at our revenue growth, profit growth, cash flow, etc., all have been positively impacted post acquisition, right? There's been no negative impact whatsoever. Uh, And the soft metrics I spoke about earlier, right? Are the clients happy? Yes, all have been there. No one's left. Leadership team, everyone's there. So from an employee standpoint, everyone happy. And from a founders who are still there, Madhav, Mir, and myself, if I speak for all, not once have we felt that this is no longer my company, right? I feel as invested, as much of an owner and vested in this company as I was before. I've gone from a significant majority to a significant minority shareholder, but it has made zero difference in my emotional attachment to the company. And for that, lot of credit to Craig and the larger Merkle leadership team to treat us as partners and not just as a majority owner of sort. In terms of how could data analytics help, etc. Again, yes, I think in general, yes. I don't know names, but I know there are increasingly a lot of modeling and analytics tools being put to bear through the whole acquisition life cycle, right? From identifying which could be potential targets upcoming in the market in the next, say, 12 to 18 months. So at the screening stage, in the due diligence, now there's so much external data. See, usually in a due diligence phase, there's a limit to how much data you can share, but you can combine that with a lot of external data around competitor information, inventory, interest rates, blah, blah, and do much more frequent forecasting, modeling, etc., to determine, do scenario planning, basically, to see where you could land, and technology to put to use to further determine what are the best synergies, etc., that you can. And I think it'll be good to deploy, to your point, right? Because if as valuations become more rich, you better find ways to really justify that rich valuation. And I think their data analytics could be useful.
What about you, Craig? We just heard Sunil and really giving out the floor to you in terms of making them feel very, very valued in your organization. So,
Yeah.
what really stands here? Yeah.
Well, to the primary or initial question of metrics of success, I think obviously it's did we achieve the financial outcomes that we projected that we were going to, in order to get to the valuation that you ultimately got to. And so as Sunil pointed out, whether it's it's growth, profit, and obviously and margins, and so that's that's the obvious. I think the other is on the is about did 1 + 1 really equal 3, right? So what caused momentum, right? And was it the intersection of the two companies that created momentum? And so that's super important. I think the other thing that you need to look at is, as we talked about, is do you have good partners? Are your cultures aligned? What do your employee engagement scores look like? At the company that you acquired, how have they changed over time? What are their attrition rates look like? Are they getting worse or not? These are all things to measure to say, was it successful or was it not successful? In this case, I think it's been tremendously successful for everybody involved. And so anyway, those are my thoughts on metrics. I think it's just your traditional financial metrics, and then it is, a lot of cultural metrics and employee metrics that really will lead you to the path of was it successful or not.
It is so lovely to see a successful M&A brewing right in front of you, both from a seller's perspective and buyer's perspective, and so much of meeting of mind happening here, and so much of respect and camaraderie for each other. We spoke about quite a few things. It's been an extremely insightful conversation. But since we also have you, Craig, here, I also want to understand from you that this entire pandemic-induced growth that we are seeing right now, um, digital transformation, technology seems to be the heart of it. What really are the pockets which you think, in terms of sectors or subsectors, which look very frothy to you and unsustainable? And what are the new areas which you think are of huge potential as we go forward and perhaps are not so discovered?
Yeah, yeah. So first of all, I think that we're moving to a world where customer experience transformation is the way that a brand is built. So the way that a consumer has an experience across sales, service, commerce, and marketing determines whether they're going to be a long-term customer and a loyal customer over time. So services that are able to integrate those touch points for a customer in an effective way using data technology and analytics, typically in a digital environment, are going to be, frothy opportunities for the future, because it'll create competitive advantage for brands, and brands are going to invest heavily in this space. I think obviously e-commerce is, we've seen, in the US as an example, we saw e-commerce grow, 10 times what it grew in the previous 10 years in the first 6 months of the pandemic, right? And that's because, consumer behavior was changing and everybody was doing it online. And we taught a lot of people, even, baby boomers, how to use technology, to engage with brands in a way that was forced because of the situation that we were in. So I think e-commerce and anything around e-commerce is going to be. I think social commerce, which is a topic that has been discussed a lot, but I put myself in the seat as a consumer oftentimes to look for trends. A great example is I'm a golfer. I've bought basically 5 brands over the past 20 years of golfing. And now in probably the last year, I've experimented with more than 10 new brands because they're in my Instagram feed, they're in my Facebook feed. Those platforms know that I'm a golfer, and they're showing me new, innovative brands that are probably very small in nature. And I can order one shirt or one pair of shorts. It comes, if I like it, I keep it, and I order 5 more in different colors. If not, I send it back and I'm done, right? And I move on to the next one. So I think direct to consumer is also a huge trend, and we will see a significant amount of companies developed in the next 5 years at an accelerated pace that we have never seen in terms of the growth of new companies, because everybody can put themselves into business. And also we're seeing the fact that, those brands that were disrupted or intermediaries sit between them and the consumer, like a CPG manufacturer. They all realize the importance of having direct one-to-one relationships now. And so they're building out those business models to deliver that customer experience that happens across sales, service, and commerce in a direct way. So those are the trends. Those are the hot areas from my perspective.
Sunil, what your areas? We spoke about experience management, you spoke about direct to consumer, social commerce. What really do you think are the spaces or areas which are perhaps undiscovered and could be very, very potentially big in the near future?
So while all that he said is, I completely agree with Craig. The additional perspective is to enable all of that to happen, there are lots of data, technology, and analytics going to be required, right? And that part is rapidly changing. There are new techniques, new technologies coming up. So that in itself provides a great opportunity, right? So to deliver on the experience that Craig spoke about, for example, you need the underlying, insight generation platform, then you need the foundational cloud platform. So through the partnerships that Merkle has as well as Ugam has with some of his companies, right? Adobe, Qualtrics, AWS, Salesforce. Having expertise or capabilities around that is a huge hot area. And we're investing in that, we are growing that. And I think companies who are able to capitalize that will help us deliver and help brands deliver on the kind of consumer experience that Craig spoke about. So being in the service provider space to help brands and companies to offer these experiences, I think it's a great place to be.
Okay, my last question to both of you, since we have this business leaders, before I get into the rapid fire, is that we are at a very interesting juncture right now. We saw this pandemic-induced growth, which actually opened a window of opportunities for few and some challenges. Craig, as you are building out Merkle for the next 5 or 10 years, and there's entire narrative building out about future of jobs, future of works, the future bit is being talked about for everything that we do, future of everything, so to speak. Two biggest opportunities in your mind and the biggest challenge as a business leader which keeps you awake in the night, what would that be? And I have the same question for Sunil.
Well, the first challenge is just like we're talking about, we're living in a consumer expectation economy. We're also living in an employee expectation economy, right? Where employees are looking for flexibility in terms of the way that they work, and they want to, blend their work life with their personal life, and they want to be able to work from wherever they want to work from. And I think a big trend is that employers have to be able to. First of all, it is a incredibly competitive labor market right now, and all industries basically are feeling that. And so you have to work really hard at providing an innovative platform for the way that your employees feel about the company that they're a part of. So every day you got to be working on culture, and you've got to be working on innovating in terms of the way that you engage your employee base. So that would be my first point about what kind of keeps me up at night and what you need to focus on. And then the second point would really be about, because it's an ever changing, you have to be incredibly curious and learning. Your learning agenda has to be, constant, right? What got you to where you are today is not going to get you to where you need to be tomorrow. So you got to have a ferocious appetite to learn, because the market is moving so quickly. And so, you can't become stagnant, because you've got to continue to innovate, and you've got to skate to where the puck is going to be. I know that Sunil will use a cricket analogy. I just used a hockey one for you, but any event, those are the two things. How do you make sure that you continue to innovate on both your employee side and in terms of what you offer to the marketplace and to your clients to create value?
It's very well said. We're not only living in a consumer expectation, but also an employee expectation economy. Sunil, what about you? You just heard Craig, and what really would be your concluding remarks on this?
Yeah, so firstly, one is future of tomorrow. Was we are still not out of the pandemic yet. So frankly, what I do, one of the things that worries, I don't know how this will evolve. I don't know how many more mutations, how many more years before, if at all, and what normal it gets to. So while yes, all this there is and should be optimism on the growth opportunities, at least I don't want anyone to forget that we are still in the midst of a raging pandemic, which is not over yet. So we absolutely cannot keep our guard down. So that's one that does constantly be at the back of the mind. And secondly, linked to what Craig was saying, that the, therefore, how this whole future of work is evolving, how to, and you're growing like crazy, there is attrition, and there's this expectation of being working from anywhere, everywhere, etc. What's the right balance? What's the right configuration? What's the right model whereby it can be, the expectation of the employee, the company, and the customers all can be met, right? And frankly, it's a grand social experiment at a global scale like never before. I don't think anyone has the answers. It will keep evolving, and getting that right, getting that magic right, I think it's very hard, and that keeps me up, right? What's the best configuration of this new future of work such that we can maintain our cultural fabric and not dilute it, right? Because to the point we've been discussing now, almost to a point of repetition, that if we all believe that culture is the ultimate competitive advantage, how to maintain and sustain that in such an environment where, in our case, right, we are today 3,200 employees. 50% of them have joined us since March, which means since the pandemic. So half our employees have no physical connection they've never been to an Ugam office. They've not met their managers or their fellow colleagues. And further off that, 20% are freshers for whom it's their first job ever in such an environment. So you can imagine in such a setup how to maintain and sustain our company culture when half the guys haven't seen us. So and this is going to continue to grow. So
Sunil's going to spend the next 6 months going door to door to meet everybody.
wearing a mask.
Where is that?
That's interesting. On that note, on a fun note, it's time for some quick rapid fire. We had a lovely, insightful conversation here today, and what real on-the-ground insights shared by both of you. I'll begin with you, Craig. What's one sport or activity that you think should be added to the Olympics?
One sport or activity that I think should be added to the Olympics.
Say cricket, Craig. Say cricket.
I don't really have a strong opinion here. So I'll just do what Sunil told me. That's what I usually do anyway. So.
And what are you Netflixing these days?
What am I Netflixing? I am watching. Let's see. I'm watching a show called You right now, and I'm also, and I can't think of the name of it, but I'm also watching a new one by Kevin Costner where he's the executive producer and he's also the star of it. That's what I'm bitching right now.
Okay, and what is the best piece of advice that you've ever received?
Good is the enemy of great, and it's not a piece of advice. It's from Jim Collins' book that is called Good to Great. I think once you accept good, you have very little opportunity to become great.
Wow. And the one advice to companies struggling during pandemic, what would you tell them, those who are ready to give up?
Well, one is I would tell leaders to over communicate, right? Communication, tell your employees, talk to your employees regularly, show them empathy, have them understand that we're all in it together. For leaders of companies, what I would tell them is, you have to create time for your own mental wellness as well. So you have to take time for yourself. And you have to recharge the batteries, to bring yourself energy and then to bring that energy to your team.
Great. Sunil, over to you now. What is the best piece of advice that you have ever received?
Is that whatever happens for the best, right? So you focus on the present, do the best you can, and then leave the rest. And I completely believe in it. Whatever does happen, ultimately does happen for the best. And I've seen it n number of times when in the moment I thought, oh my God, the world has come to an end, but ultimately it doesn't. So I think that's the best piece of advice I've got.
And what's a skill you have always wanted to learn but never got enough time to do it?
Oh, that's easy. I've still not done it. You see the guitar at the back? That's the music. I'm in my son's room. That's his guitar. I used to play the guitar when I was a kid, and I'm looking to get back to it. So yeah, picking up a musical instrument is number one on my list.
Okay. And what is the biggest misconception about M&A that you would like to share?
Biggest misconception. That's this one. Yeah, I guess biggest misconception would be, yes, that you can quickly, make a company, grow it for 2-3 years and then flip it around, right? I think like Sam Walton said, right, when they went public for the first time, like every overnight success, we were 25 years in the making. It takes time to build a good company. It takes time. Yeah, you can get lucky. You can be able to flip something and sell it in 3 years. But by and large, any good company just takes time. So there's just no substitute for that to happen.
No substitute for hard work. Amazing conversation. My last question, what did both of you like the best about this conversation today? Sunil on Craig and Craig on Sunil.
Nothing. It's always great to meet Craig. I have every Friday morning. I have his Friday morning, my Friday evening. We have a one-on-one. So is great. And finally, I could see the size of his wallet. So.
So first of all, as I said, Sunil's become a close personal friend. So anytime I get to engage with him, I enjoy myself, even in, a setting where we're being interviewed. We have a lot of our own opinions. We have a lot of shared opinions, but we also, like to have fun with each other. So that's my favorite part.
Gentlemen, it was my sheer pleasure and privilege to have both of you, and I'm sure it will be very enjoyable and insightful to our readers and watchers to go through this interview. Thank you for your time and energy for this. Till time I see you next, goodbye and good luck. Thank you so much.
Thanks
a lot. Bye-bye.